Good morning and good afternoon to all our listeners, and welcome to the panelists. I am Oshani Pereira at the International Institute for Sustainable Development. I lead the program on infrastructure, and it's fantastic to welcome you all to this webinar. We're going to be talking about why sustainable infrastructure is not happening now, and it is extremely important that it does happen now. And we'll talk about that presently. On the panel, we are delighted to have Howard Mann. He is the Senior Legal Advisor at IISD, and he's worked over the years on many aspects of investment and infrastructure. We have Bruno Alves. Welcome, Bruno. You are the editor of Infrastructure Investor. Fantastic to have you with us. We are all avid readers of your work, and thank you for taking the courage to begin to feature sustainability so boldly. We have Motoko Aizawa, an old friend of IISD. You are the president of the Observatory on Sustainable Infrastructure, and you have extensive experience in this sector, including and especially on environmental and social safeguards. Motoko, welcome, and thank you for making the time to be with us.
Happy to be here.
A quick point before Howie begins as to why it is so important that at this point in time, we understand why sustainable infrastructure is not working out. So a why on the why. Right now, we are at a time when the Great Recession of 2020 is not turning into a Great Depression. When we look at market participants, thank you, Cesar, thank you. When we look at how market participants are behaving, some are expecting a V-shaped recovery. Others are saying output will remain depressed, demand will remain depressed. There'll be a lot of deleveraging across supply chains, deleveraging meaning that when revenues fall, you're beginning to sell off assets and inventory. And so therefore we might be looking at a double dip recession. If that happens, the importance of public spending on infrastructure will increase. The second point I want to point out is how financial markets are behaving at the time of an economic downturn. So all the losses on stock exchanges at the beginning of the pandemic, 30 to 40% in some cases, have now been recovered. And this recovery kind of tells me, and maybe Bruno will talk about this during this hour, is that the environmental, social, and climate risks are the probability of environmental, social, and climate risks are not being understood or appreciated by market participants. So, you know, it's what we call a tail risk. We see a bit of a fat tail risk at this point. Sometimes we tend to refer to them as white swans. Risks we know, we see that are looming, but we don't know how to assess the probability, and so therefore we don't really price them in. And the pandemic itself is a sustainability risk because zoonic risks are going to increase as there's deforestation, and we humans have more and more exposure to pandemics and species jumps. We have widespread drought and widespread desertification. That accounts for the locust storms all around the world. And that is going to account for a huge amount of human migration into Europe and into North America. So we can go back to the cards, Cesar. In this context, where we have tail risks and the probability of tail risks not being understood by the wider economic and financial audience, I would like to invite Howie Mann to start us off. Now, Howie, you have been asking me over the last 7 years this question. How come infrastructure asset managers taking positions in what is called distressed assets in developing countries are expecting and showing double-digit returns, especially on funds of operation? You've also asked me several times, where is the logic of going from millions to billions, as the MDBs and development partners often talk about, using public money to de-risk private money for public goods and services? Start us off, please, Howie.
Thanks, Motoko. Hoshani. That's a tall order. In a way, my brief here to begin is a little bit more on the taking down some ideas side, and then hopefully we'll follow with some building up some ideas in the next with the next speakers and rounds. My concern with this, first, I don't come at this as being an infrastructure expert. I start from the side on investment and sustainable development, and what does that mean? And one of the critical issues is always access to finance, access to the financial resources for different projects, whatever the sector might be. And I think what's happened over the last few years in the infrastructure side is, especially for developing countries, which are the countries that we necessarily are most worried about in terms of access to resources, access to new infrastructure, where massive infrastructure deficits are hardest to overcome and recover from the impacts of. And in that context, when you look at the linkage that the development banks have been made between infrastructure and PPPs, to the point where many developing countries have simply renamed their infrastructure divisions as PPP divisions, because that has become the only way to access resources. But if we look at it, and whether it's millions to billions or billions to trillions and cascading finance and so on, the whole notion of infrastructure as an asset class for funding infrastructure development, and we look at the means to achieve that end that the World Bank in particular has proposed, which is de-risk and de-risk some more, I think we see a very troubling result. That's my view anyway. The track record on infrastructure as an asset class, there's no question there is a large number of very successful development funds. And I used to have an investment in one of those funds as well. And I think there's some logic in it. But the pattern that we see in how those massive funds are being used is somewhere between 80 and 100% is being spent in developed countries or India and Brazil. In other words, the economies that need it the least is where we see it being spent the most. Partly that's because of economic security, partly that's because of perceptions of lower risk, but that's the reality. And the other half of that, the other side of that is virtually none goes to the developing countries where the infrastructure deficit is the greatest and the hardest to overcome. And one of the elements that we see coming with that is these apparent demands for rates of return that are running into the high teens and even into the 20s in terms of percentages of rates of return. And a rate of return here is essentially simply profit. And it's profit that skims right off the top in terms of getting the financing and money that then leaves the country. So it's not just a question of interest as the cost of finance here. It's that profit margin that becomes part of the cost of finance also. And where does that profit margin come from? Ultimately, it comes from the users in those countries who who are essentially the users who can least afford it. And with the development banks turning to PPPs as really the main vehicle or main process for developing infrastructure, you have a real mismatch. And my argument really comes down to very simply that infrastructure as an asset class is actually now working to deprive developing countries of the resources, in part because the funds have been very successful in raising huge amounts of money, but that money is directed to developed countries and infrastructure in those countries rather than infrastructure where the development banks need to be most focused, which is in the lower income, least developed and middle income countries. So I think there's a real mismatch between the strategy and what should be the objective there. And that mismatch is really systemic, and I don't see any way to really overcome that in terms of how the process works. The primary tool that the World Bank in particular has proposed to overcome that mismatch, that strategic mismatch, is legal de-risking. And their proposal for PPP contracts between private sector service providers and developing countries really focuses on de-risking provisions that move virtually all of the liability onto the government partner. Climate change impacts, government liability. Force majeure, government should take the liability. Company doesn't complete the project, pay them anyway. The project quality isn't delivered on, pay them anyway. Change in law, pay the company to implement it. The only concession really in the last round to that strategy of complete de-risking, legal de-risking, was the bank provisions in 2019 actually recommended the host country law be the law governing the contract as opposed to the colonial powers law being the law that governs the contract. And that shift was just made in 2019. So there's a real issue in how that works. But beyond the questionability of that kind of approach of shifting virtually all the risk, the reality is, and we know this from other sectors, especially the natural resource sector, where that kind of de-risking has been going on for 20 years, the fact is it doesn't lower the operational risks. And I think Motoko and Bruno will talk a little bit about this, what kind of approaches do lower the operational risks. We know from those other sectors that that approach of legal de-risking often presents a false sense of a good investment environment, but it's a false sense. And in many cases, it's actually increased the risks of investors who take that approach. And we see that in the so-called resource nationalism response, for example, in mining and oil and gas in Africa. So I think there's a lot of issues, and none of that even begins to sort of incorporate the litany of problems with PPPs that we've also seen in developed countries, quality, being on time, being on budget, and so on. That has just led Boris Johnson to say that PPPs will not be the core part of the future of British infrastructure development. So we see a lot of issues with the process in countries where it supposedly works the best, but we see systemic elements, I think, that really prevent the transfer of that tool to be the defining paradigm for infrastructure development in developing countries looking forward. So that's kind of my starting point. As I said, it's more on the negative side, what isn't working, and I hope that Bruno and Motoko will start to look more at what can work.
Thank you, Howie. We will come back to the legal de-risking and unpack that a little bit more. An essential part of what you said is, of course, happening because the moment the government begins to de-risk, generally it moves off balance sheet. And when there is an issue, and when you are required to live up to all these guarantees that you've made to de-risk, and the guarantees are being called, it's off your balance sheet and it pops up as a surprise, governments don't know how to cope with it. And we've seen this happening in developing countries. And I really applaud Infrastructure Investor and Bruno for actually printing this. And I'm going to try to show you a copy. It's Infrastructure Investor of February 2020 that asked the question, PPPs, and is it time to bin them? Bruno, could you give us some highlights from this issue, please? And also tell us why you decided to focus on it.
Sure. And thanks again for inviting me, Oshani. So just very briefly, I mean, I think some of your viewers will know, but we write a magazine mostly for private capital investors in infrastructure. And in February, we decided to do a deep dive into what's happening with public-private partnerships, because, we've been tracking, we know this was a widely used procurement framework in the developed world, and now increasingly in the developing world, but we also know that it's been in a developed world somewhat in decline, and it's been besieged by issues. And so we decided in February to go have a look and to try and see if we could find out what is going on with the procurement framework and whether it could be improved, or whether it was time to ditch it and look at other alternate methods of channeling private investment into public infrastructure. So actually, I should say this was an analysis completely focused on the developed economies. And we did that on purpose. We chose the developed economies because we felt that there had been a long track record of usage in these regions. And we thought also that whatever lessons we would find, good or bad, would be anyway relevant to the developing world, where we recognize that there's a lot of the PPP procurement is now being handled these days. So what did we do? We spoke to around 20 industry sources to try and find out what's ailing the model. And very broad kind of brushstrokes conclusions. We found two main conclusions. And the first one was that the acceptance of PPPs in the developed world these days is varying greatly by geography. So broadly speaking, the Australasia market, Australia and New Zealand, is broadly favorable towards the model. PPPs, I would say, are facing some serious questions across North America. They've always had a patchy track record in the US, but they were widely used in Canada, and there are questions hovering over the model across the continent now. And you could say the model is somewhat in decline across Western Europe compared to a few years ago. You certainly have deal activity, but you don't really have champion countries in Western Europe. And as Howard pointed out, it is outright dead in the UK, where it's known as the Private Finance Initiative, and it's become politically poisonous. So that's a very kind of summary geographic picture, if you want to. But what is actually going wrong for PPPs? And here we found a kind of a laundry list of troubles. And they include inappropriate risk allocation, contractual rigidity, lack of clarity about value for money, a sort of public-private disenchantment with the framework, and also lengthy procurement processes, which seem to be landing some of these projects in trouble. So just to kind of give you a couple of examples. So take an appropriate risk allocation, though this perspective might be a little bit different from what Howard said, but this seems to be a problem that's popping up a little bit all over the developed economies. And what seems to be happening in a lot of places is that in their urge to win projects, some private sector consortiums are taking on a lot of risk, and then, for example, passing on that risk to the contractors in these consortiums who actually have to go and build these projects. Or you have a case where you have over-leaguer contractors that take a view that they will put in very aggressive pricing and will then litigate away any troubles that might come up. So what you seem to be ending up is in a place where through, both the public and the private side create the conditions for an unsustainable project. And you then have to deal with the consequences down the line, such as cost overruns and, or even outright collapse. And so we spoke to private and public sources, and the solution seemed to be a much more sort of conscientious case-by-case approach to using the framework. Because I think, as has been said here, if certain of these risks, the transfer, if the PPP is not done correctly, can be a little bit illusory, because the public sector can get, the risks can come back to the public sector. So that's, that's one of the conclusions that came up, is that, and there was a quote from one manager which was particularly powerful, that he said, and I quote, that PPPs are not a panacea, they're not a magic wand, and they really have to be used, with a very kind of conscientious approach. And the public sector shouldn't enter into them if they don't feel they have the adequate skills to conduct a proper analysis. So that's one conclusion. Another complaint that kept coming up was contractual rigidity. So once you enter into these contracts, they reveal themselves to be too inflexible, and they're not really well adapted to today's needs, whether they're environmental needs or technological, or regarding evolving customer needs. So one solution, for example, and this was proposed by a North American fund manager, was to turn PPPs into what he called, a living contract. So the public and the private sector commit to working together across these multi-decade contracts, but through a sort of living agreement that evolves, with the needs of both parties. And, these are just two examples. I could go kind of bit by bit into what I found. But maybe not to be too negative also. We also found still that there were good things, at least from the industry's point of view, regarding PPPs. And for example, this was maybe more evident in markets like Australia, which, as I said before, are still very favorable to the framework. And one of the positives that came through across regions was the whole life approach to developing and maintaining infrastructure assets that come with PPPs. Which the market finds results in higher maintenance levels, and also ensures that there's a budget to maintain these projects, which sometimes arguably doesn't happen when projects are 100% publicly procured and money needs to be diverted to other priorities. And this is a little bit different from what Howard said, but the reliability of project delivery, at least in some of the developed economies, seems to be seen as another of the big pluses, that these projects are delivered on time and on budget compared to their publicly procured counterparts. So this is kind of my speed through some of the issues that we came across in our cover story. And the gist of it, if you want, is that the model needs to be reformed. I don't think we came across anyone that said that it should continue as is. The idea was the model needs to be reformed, and that conversation needs to be had. But we also didn't come across people who were willing to completely, kill it. And that's what we did with our deep dive. And this is kind of my speed run through some of the issues that we found.
Thank you, Bruno. That was indeed a very detailed speed run through. The question that Rick Walters is asking, Rick, thank you for joining and nice to see you on our webinar, is, so if de-risking is not the answer, what are you recommending? Are you saying that fundamental problems around risk in developing countries remains an issue that cannot be solved? I will let our panelists reflect on that and take it up as we go. A moment ago, just as Bruno said, all the people that he interviewed said, we have to reform PPPs. I'm wondering whether you can give us some thinking on that, especially in the work you've been doing in looking at the new breed of emerging post-COVID public and private collaborations. For example, on vaccines, on healthcare, on R&D, on digital infrastructure. Portugal.
Thank you very much, Oshani. Thanks for inviting me to be on this panel. I've heard the previous speakers' points with great interest, and I guess we're trying to chip at this mystery of why sustainable infrastructure is not happening, and I will be chipping at it too. Bruno mentioned this public-private disenchantment, which is in your article. I guess that's a very nice phrase that captures the sentiment. It's just that that sentiment applies both ways, right? So if you ask the private sector, they think they're taking on too much risk. If you ask the host country, they feel they're taking on too much risk. They have other slew of perceived problems. And you could say this enchantment is three ways if you ask the civil society organizations and likes like us, that these infrastructure projects are simply not contributing to sustainable development sufficiently, that countries are missing that opportunity to really max on their SDG attainment. I heard with great interest the recent OECD PIDA conference in which African leaders didn't mention the word PPPs all that much. In fact, one said it's all going to be national funded projects, and we're going to turn to pension funds to fund our infrastructure needs. So the tide is definitely turning. It has been turning for a while. And I would say that the pandemic is really creating new challenges to existing PPPs with capital flight, with liquidity problems, with unsustainable levels of debt besetting the host countries. Bruno already mentioned potential calling of guarantees and all these contingent liabilities becoming a reality, which could turn into financial crisis, austerity, or worse, potential explosion of IISDs, that's investor-state dispute cases. We know that the claim that the pandemic is force majeure is actually not that simple. That claim is going to be made by both parties, the private operator and the state, and because the state has stopped business in order to stem the pandemic, this argument is going to be bitterly fought in the arbitration process. So would there be protracted fights, lots of those, or will parties try to work it out, really? That's the point of public-private partnership, I would think. So will there be further deepening of this disenchantment about PPPs, or is there a ray of hope? And I just want to share with you some insights from the health sector, some ICT insights. I wouldn't say this is the trend exactly, but since I thank you for turning on my slides. So it's just giving us some sense of where things might be headed as we wait for the slides to come on board. And I noticed that it's taken quite a long time for the slides to turn up. So anyway, in Bruno's edition of the Bidding the PPP feature, there was a quote from the head of infrastructure at Ardian. He said, "The scheme as it is today is based on building heavy assets, but people don't expect us to deploy more and more mortar. The question is, how do we use digital innovation and technology to increase capacity and efficiency without building more?" In that sentiment, there are some R&D PPPs popping up, particularly for COVID vaccination development. This is not what you call a typical PPP that probably infrastructure investor would deal with, but there is indeed a partnership that's happening with business, that's happening with business arms of universities, the state, and foundations. And we're already getting a sense of the private sector expecting a very, very lucrative return, regardless of the effectiveness of the vaccine. That's something to watch out for. there will be more PPPs and infrastructure systems, the health system, the transportation system, energy system. So not in individual hospitals and clinics, but the whole system in order to improve the functionality of it. And that's welcome. There is likely to be asset-light PPPs that I think several people are talking about. So this is investment in intellectual property systems, as I mentioned, and investment in maintenance, which of course is badly needed, but no new money necessarily going into heavy infrastructure. And then finally, lots of PPPs can be expected in ICT because Internet of Things is going to be the backbone of infrastructure, right? So there's a lot that we don't know about this type of PPPs, in addition to all the problems of existing PPPs. Will people have a fair share of the benefits from these PPPs? Or will there be transparency and traceability of funds? And what will be the role of the multilateral financial institutions or bilateral financial institutions, because they're set up to really deal with traditional asset-heavy PPPs? So here are things to throw into the bucket of why PPPs will continue or may continue to be problematic. And finally, I asked the question, these are potential solutions for developed countries, but what about developing countries? So let me pause here, and I'd love to come back to some of these topics. Thank you.
Thank you. A couple of things to think about there, certainly. I'm wondering whether Howie and Bruno would like to come in on this point to respond to the two very important questions being posed by Rick Walters. One is on de-risking in developing countries, and secondly on the persona. I would let you all read his question yourselves, but if I might interpret it as the persona of PPPs, especially at a time of such low interest rates. Indeed, you might also ask, Rick, in today's post-COVID environment with so much public money around, would governments be spending on the next wave of infrastructure? Howie, please start us off on the responses.
Rick Walters' first question, and forgive me if I don't summarize it quite right, I hope I do, is essentially if de-risking isn't the answer to attract more private sector investment at a reasonable rate of return from the government perspective, then what is the answer? And I think my own view is that the answer to that comes in how you approach de-risking. What does it mean? Where are the actual risks? And primarily what we see across a range of sectors today is that the primary risks come from perceptions of equity or the lack of equity and inclusiveness of local communities in the benefits of the project, inclusiveness even of the target users in the benefits of the infrastructure project, whether it's energy, whether it's IT, whether it's health, or whatever the case. And a lot of that inclusiveness starts with the original design of the project, or the phrase differently, a lot of the sense of lack of equity and lack of inclusiveness comes from the exclusion of a broader range of stakeholders in the design of the infrastructure in the first place. If you're not starting from a perspective of inclusiveness from the design forward, chances are the end project isn't going to reflect the interests of all the stakeholders in a way that's optimal, and that's where the risk is really generated today. There's far less risk of expropriation of assets today than there was 30 years ago, which is what a lot of the legal provisions are designed to respond to. And the reality is there's far less impact of change in law provisions and other types of legal changes that we see. To my mind, what we see in a lot of developing countries is precisely what development aid has tried to promote. And that's the democratization of governments and governance, increased transparency, increased democratic access by populations, by communities, and so on. And that's a messy business. But that's exactly what we have promoted, we in the developed world have promoted. And that will translate to more demands for equity, more demands for inclusiveness, more demands for the design and the impacts of these projects to really focus on the users who need it and the distribution of economic benefits from that project. And those are the things that lead to actual de-risking at the operational level, not creating contracts that, as Bruno said, become very rigid and very essentially lead to a lot of litigiousness because the provisions of the contract are seen to have to be invoked in a very black letter law way without the flexibility that a 20, 30, or 40-year project needs.
I will jump into the second question. So Rick, yeah, I mean, I take your point, and I think you're right. To a certain extent, we're talking semantics because a PPP is a framework for public-private collaboration, but it's been the framework for new build infrastructure for many decades, and hence why the focus. But I guess your real question is really, you know, do governments need private money and what comes with it? And especially now we have such low interest rates, why wouldn't they fund these projects themselves? I think it depends on, I think from my experience of talking to the market on just, it depends on a couple of things. I think there are sectors like renewables and the whole energy transition and also digital infrastructure where you could argue that the need is so overwhelming that you need all the sources of capital. You need the private capital for renewables, you need the public capital. It won't get there with just one source alone. And I think, you know, and here the key is to find the structures and frameworks and to channel the right money for the right projects. But I think you would need both. And then I think there's another question here, which is, you know, which is around this question of getting the right money to the right place. So I think if you look at asset recycling initiatives that they've had in Australia, where essentially governments have been privatizing operational assets and then they channel that money into new build infrastructure. This could be a way where if you have a lot of public money, and maybe it's more appropriate for that public money to build a certain project in the first instance. And then later down the line, when it once, you know, the project is operational, some of the institutional capital that is very conservative and needs to see some operational history is ready to take on the risks that come with that project. You can then, you know, privatize or shift that project to the private sector. And of course, you know, here is where the importance of regulation it comes to the fore, that you need those frameworks. But in short, I think that, you know, it's really, it's not an either or solution. I don't think these two sources have to be in competition. It's rather using this opportunity to see which pool of capital makes more sense for which types of projects and at which point in their life cycle. So I think that's, you know, that's what we've been seeing when we're covering this. And that's how I would answer that, you know, would answer that question. I think more money for infrastructure from the public sector is a good thing, and that's going to channel more private money. It's just you know, if we can have a good conversation about how that money is used. So I suppose that would be how I would answer that, and hopefully that's answered your question.
Thank you, Bruno.
Shani, can I just jump in?
Please, Howie.
Because I don't disagree with anything Bruno said. I quite agree with it, really. I don't think we're saying anything that is actually in disagreement with each other. What the problem from a pure development perspective, a sustainable development goals perspective, is that the development banks impose the equation infrastructure equal PPP as they defined it. That's where the problem from the sustainable development and the SDG perspective is. Rather than seeing PPPs as one option that could be fit to where it works best, it became the only option that could be used. And that's the fundamental point of why it's become such a big issue for developing countries in particular and civil society organizations.
Oh, Shani, can I also interject very briefly? So I just want to address this question of why de-risking is not happening, and if so, what? There has been some studies about why the private sector is not taking on the de-risking products that have been offered by the multilaterals, for example. There are some disincentives built into the products, and so those things have to be looked at. And then eventually, I agree with Howie about the need for us to have a balanced view of what PPPs are. Even in the height of PPPs, public sector financed, maybe 90%, 85% to 90% of public infrastructure. And so PPP is a tool in a toolbox to extend the menu of options available, sorry to mix metaphors, for governments to offer additional infrastructure. And so we just have to put the whole thing in a perspective and not just go crazy about making this one option work. Thanks.
Thank you, Motoko. If you can hold the microphone, please. And just continue to tell us about why the very social fabric of free markets and open, inclusive societies is at risk when we don't get infrastructure to be sustainable. Risk is one thing, but if the very social fabric is at risk.
Yeah, thank you, Shani. I guess this is something that we are discovering much to our horror as we go through these different phases of pandemic. So, what we're seeing is that the most vulnerable segments of the society are the recipients of vulnerable segments of the population who are migrants, who are minorities, who are indigenous peoples. They are mostly directly affected by the pandemic in the sense of they're the most, also a lot of them are essential workers, right? And I also want to mention women here because they are essential workers, they're caregivers. They have been the first to let go in the redundancies. And they themselves depend on public infrastructure services. So they're actually great customers. And without taking care of their needs, we're really not going to be able to withstand future shocks and crisis. So we have to start to think about different kinds of resilience. When we say resilience, it used to be about taking into account the resilience of the physical assets of pandemic to climate risk. But actually we need to really start to think about resilience of society as a whole to future shocks and risks, right? And infrastructure has to take into account those needs. And, we have experimented with that in this pandemic. We're starting to think about more adaptable, flexible, multi-purpose infrastructure, turning convention centers and train terminals and airports into hospitals. We're starting to activate different parts of the transportation system so that essential workers can get to work more easily. And we're actually questioning the whole idea of stranded assets, right? All of a sudden, restaurants and malls and airports are stranded assets, at least for the time being. And so we're starting to question a lot of these things with the people focus. And I think that's really the key to moving forward, that those who are most vulnerable in the infrastructure building process and outcomes, whether they're affected communities or whether they're excluded communities that don't have adequate access to infrastructure. So this is a key to our future. And it also means righting the inequities of the past. And this sounds really complicated, But we're already seeing this happening in several cities. The California transportation system, thinking about the past discrimination of certain racial groups because the highways crisscross their cities in such a way to really hem in this a group. And how can we broaden and change the transportation system to be much more inclusive to their needs? The Washington, D.C., my hometown, has this reopening strategy, and it's driven by 4 values: hope, that's health, O for opportunity, P for prosperity, and E for equity, to address past inequities. And Paris Mayor has this 15 City campaign, which is about enabling people to have access to essential services with ease and dignity, right? And that's also part of inclusiveness. And so, you know, we pledged that we will do better after the financial crisis. We really, really, really need to do better this time. We need to have a very bold and decisive and inclusive solutions. And in a way, we have no choice but to demand this transformative, inclusive infrastructure. And this is for the resilience of the society as a whole. So the big question is, how do we structure and fund these kinds of projects? And again, I guess I'll just, in the interest of time, I'll just come back and say that the only thing we can say at this point is that you know, we're going to have to resort to the old and new forms of PPPs, as well as public funded infrastructure, as well as other ways to fund these public services that we have to use, mobilize the entire tools in the toolbox. But every one of them will have to take the people's needs seriously. Otherwise, they really don't deserve to be part of the toolbox. Thanks.
Thank you, Motoko. Listening to you, I would like to ask Bruno about how institutional investors are reacting in the current climate where governments are asking for building back better and fairer and greener. They're asking, as Motoko said, for more inclusive infrastructure. There's also a lot of public money around. So at least in richer countries, are we going to expect that governments are going to be funding the next wave of infrastructure? Are digital assets where institutionals are looking for a piece of the pie? Bruno?
Thank you. I really want to address the point Motoko made about inclusiveness and what I'm seeing with how institutional capital is reacting to that, because I think it's crucial. I think it's probably at a very incipient stage, and I think it needs to move much faster. But certainly compared to a few years ago, you see movement. And from an institutional point of view, and I think it's really important, it's that the contributors, the people that give money to the fund managers, the pension funds, et cetera, really demand this social equity and this inclusiveness. And you can see incipient signs of that happening that I think are encouraging, we're nowhere there, but they're encouraging. And to give you one example that happened in March. So right at the start of the pandemic, we had some of the world's biggest institutional investors, which was the Japan government pension investment fund, the California State Teachers Retirement System, and in the UK, USS. And they put out a letter, a quite extraordinary one, attacking what they termed short-termism in asset managers and companies. And they effectively said that companies that seek to only maximize corporate revenue without considering their impacts on other stakeholders, including the environment, workers, and communities, put their long-term growth at risk and are not attractive targets to us. And they were effectively saying that, if you pursue a sort of scorched earth strategy where you don't, ensure that you keep your social license to operate, then you will, we as long-term investors, we don't want to be part of it because we don't think those investments are going to be sustainable. And I think that's more and more of those voices are forcing and bringing a dialogue which has been happening about how you keep your social license to operate as a private investor in infrastructure much more to the front than they were. And to give you another quick example, basically in Australia, and to come back to public-private partnerships, there was essentially a report put out in June by Infrastructure Partnerships Australia, where they deemed social license to operate as a critical factor in the success of infrastructure projects. And they outlined 9 principles all of these projects should keep to. And so I think there's a lot of work to be done there. I don't even want to pretend that there isn't. But I think the conversation is now being had. And the more these pools of capital demand that these principles and these ideas and this social equity and license to operate is at the forefront, the more this will happen. So I just wanted to, to put that briefly in, because I think that's where a lot of the change will come from.
Very valuable insight, Bruno. Thank you. So everybody's asking for inclusive infrastructure, it seems. We're heading for interesting times. Howie, can you tell us what has changed forever after COVID-19 in the sustainable infrastructure horizon?
Well, I wish I had a magic ball that gave me the answer to that so easily. I think to me, there's 2 critical issues that we now see. And I suppose there's really a lot more, but I'll start with my top 2 anyway. One is the notion of accessibility and inclusiveness and built-in redundancy. I think we're going to see the development of multiple access points for infrastructure. The healthcare system is probably the most obvious example of that, where around the world we now see home access to doctors. The house call is coming back, but it's coming back in the form of remote technologies. But my mother is now getting house calls from her doctor over her iPad, where she used to get them in person. And that's going to change a lot of the approaches. We're going to see that same shift in how we conceive of work today and where people work. And that's going to come back, tie in also the question of access. How do you access work? It's going to tie in with the question of carbon neutrality and zero carbon design. And I think that's going to be the other really critical central feature of infrastructure design over the next few years. That major shift that we see a lot of governments building in now to building better, the notion of building better. And in a sense, we may be at that now or never moment in terms of shifting to carbon neutrality and zero carbon factors, zero carbon approaches. And how that's going to relate to how we work and where we work will be critical. And one short example, really easy example, is urban transportation. All of the urban transportation models are built around people living in the suburbs and commuting to a downtown work core. Well, we've seen that disappear over the last 4 months. Rush hour traffic doesn't look like rush hour traffic used to in many, many places, in most major cities. We see people working from home. We see work life space, work living space become a reality. And how are we going to design for that? In Ottawa, near where I live, last year they opened a PPP on a light rail transit system specifically designed around the rush hour transportation model. And it's probably already outdated in a city like Ottawa, where that rush hour focus is the core element of the design. Work from home needs a very different infrastructure that also fits with a carbon neutral and zero carbon environment. Even if it isn't work from home, if we move to more clever designs, urban designs that doesn't focus on the downtown core as the main work center, we're going to be shifting transportation needs, and that is going to create very large differences in how we look at infrastructure over the next few years. And I think that coming with that is also going to be a more broadly based focus on ecosystem-based or nature-based infrastructure. How do we use the natural resources that we have in a way far more efficiently and effectively from a public service and an infrastructure service perspective over the next few years, instead of essentially dismantling that nature-based infrastructure to put in built-in man-based or people-focused infrastructure, instead of using the nature that we have to provide those services. So I think those are some of the most critical issues we're going to face.
Thank you, Howie. Would you also answer the question from one of our listeners who asks about the flexibility of contracts? Jean Izamu is asking, the PPP contracts are long-term and considered to be rigid. On the contrary, sustainable development priorities might evolve over the life of the contract. How do you ensure legal certainty, at the same time flexibility to answer to sustainability's changing needs?
Yeah, and I think that's a really good question, a really astute question. Part of it is that, and this is part of the impact of the World Bank's model provisions and other types of contracts that reflect that notion of the contract has to be rigid. That's part of the problem. And we need to be able to move away from that to find ways that build in flexibility so that priorities and who gets the services, how the services are delivered, can in fact change over time. And as technology develops, the contracts don't become a barrier to adopting those new technologies, but instead become a propellant to adopt those new technologies in the provision of services. And I think especially in the infrastructure sector, probably more than any other, there's the need for true local stakeholder inclusiveness in the original design process. Too often, design is focused on an engineering component. How do we engineer this type of project, instead of asking the question, what are the goals we are trying to achieve with this project first, and getting inclusive input into that question so that the design reflects the sustainability requirements of the people most impacted by that project, whether it's as users, whether it's because the project is in their community or linking different communities or whatever the case might be. We need to get that input to define the values that the project needs to serve, the objectives that the project needs to serve, and then build in the flexibility to adjust those objectives and values as time moves forward. And all that can be done if we move away from the concept of contracts must be rigid.
Thank you, Howie. There's one question that one of our listeners asked, and he asked about whether sustainability itself needs to be redefined. Hamidullah asked us that. And you're absolutely right. Sustainability today is resilience and inclusiveness. And on that note, I would like to thank everybody for being here this hour with IISD. The recording will be posted at the link that Lauren Wunenberg has kindly indicated on the chat, and watch the Sustainable Recovery website for more news, views, and of course, more webinars, including the 2 next webinars happening in September with Motoko and Howie. Thank you so much. Bye.